Hello, passive investors. Welcome to Passive Pockets presented by Equity Trust. I am your host, Jim Pfeiffer. As you know, a critical part of investing is knowing who you're investing with. So today, we're going to meet Ben Fraser from Aspen Funds. Let's jump into it. Ben, welcome, and thank you so much for supporting the Passive Pockets community.
Jim, thanks for having me on. Looking forward to it.
Yeah, you know, you're one of our longest partners. I think you might have been the original partner operator we had at Left Field Investors. So this goes a long way back, and we really appreciate that. But let's start out. Just tell us about Aspen Funds. What type of real estate do you guys focus on, and what do you do?
Yeah. Well, thanks for bringing me on, and love the long-term partnership that we've had with you and Passive Pockets now. So super excited. A little bit on Aspen. We've been around over 12 years and actually started in distressed debt, seeing a unique opportunity coming out of the great financial crisis, being able to buy distressed mortgages at deep discounts. And that really launched us into, one of our core verticals that we're in now. But, really that business has been around. We still continue to operate it for over 12 years. And we've expanded into other verticals, based on our expertise that we have, but using kind of a similar approach to what caused us to jump into distressed debt in the first place, which is what we call macro-driven investing. So looking at big macroeconomic trends that are driving unique tailwinds in certain sectors of the economy, and then positioning ourselves in the way to benefit from those trends as investors. And so we've expanded to about 4 verticals. We continue our kind of debt and credit verticals. We've expanded from just residential mortgages, which was the first genesis of those funds, into commercial credit. My background is as a commercial banker and underwriter. And so we have a lot of activity in that vertical right now, given some of the unique things going on there. We've expanded into development of industrial projects. We're very, very bullish on the industrial. We believe the new 2.0 boom of the reshoring and manufacturing trends that are coming back to the U.S. We also invest outside of real estate into oil and gas, into a unique kind of strategy there, buying existing operating fields and then drilling on top of that. So a few different things, but we are in each of those for a very particular reason that we think is backed by strong long-term tailwinds in the economy.
And how do limited partner investors get comfortable with Aspen? Because you do, so many different, almost unrelated things. I know they're all tangentially in real estate or whatever, but if someone's looking for someone who's focused on one thing and Aspen's doing 3 or 4 things, how do we get comfortable with, hey, you have the expertise to understand all these different asset classes within the real estate bubble, I guess? Yeah,
it's a great question. So the oil and gas kind of put a pin in that, because it's pretty different. But in real estate, a lot of them are tangential. And from my background as a commercial banker, we look at what's the worst case scenario, how do we underwrite, how do we understand the drivers of the business plan, of the growth. And there's some differences in different real estate asset classes, but on the lending side, it's a very different perspective, right? Because you're looking primarily at what's the downside risk and how do we mitigate that? How do we understand our leverage? How do we understand if we have to take over a deal or a project? Right, and it's important to understand the market. Important to understand the vertical that it's in, and we don't invest in anything that we wouldn't feel comfortable taking back if we had to. But I'm one of 4 principals. I'm the youngest by about 20 years, and across my 4 partners, we have very deep experience actually in development of industrial projects, in development of residential projects, and running hedge funds, in doing lending and banking, and then also doing owner-operated real estate. So, I'm the youngest of the crew, and my partners have a lot of experience and a breadth of experience, right? And so we do a few things really well. We don't do everything, right? And I think that would be a pretty big red flag. But for us, it's understanding where we think the outsized potential is going to be in the verticals, and then we go build teams around it if we don't already have the expertise in-house, which the verticals we have right now we do, and then we'll build from there. On the oil and gas, it's a little bit different because we don't have the deep experience as we do in real estate, and so we've partnered with another firm that does have that deep experience, have a 40-year track record and historically have only ever raised money from family offices and institutional investors. And we were able to partner with them a few years ago in our first kind of joint fund to bring retail investors alongside of the family office and institutional investors. And we rely fairly heavily on their expertise, but all that's in the data rooms and pretty transparent, and people can see how those relationships are working together.
And talk to us a little bit about how you got into real estate personally. I think you were a mortgage banker of some kind, or commercial banker, I think you said. So was that your entry into real estate? And can you talk about kind of briefly your real estate journey?
Yeah, absolutely. So, I was kind of, corporate for a while, did a finance degree, did an MBA, went to work in kind of boutique asset management for a large institutional money manager, but then made my way into commercial banking. And I kind of view that as my primary education with real estate in particular, where I was an underwriter. I would go in and pull the personal financial statements and of all the principals. I would look under the hood of the deals, understand the business plans, and put together pro formas, and was really able to learn how to look at real estate, how to assess the in banking terms credit worthiness. Right? Is this worthy of lending, worthy of credit? And it was a really great kind of base for my education of understanding how to look for good deals and to invest in good deals. The challenge for me as someone who's fairly entrepreneurial was after a while, it got a little bit tiring, because as a banker, you only have downside risk, right? You don't have any upside. You don't get to enjoy if something works well. And so it actually creates this pessimism that I saw with my colleagues who are much older than me that I was not attracted to for a long time in my career. So had the opportunity to join Aspen Funds about 8 years ago to really kind of help scale and build the platform that they had already started a few years prior. And it's been a great time. I've learned a lot along the way. I've been a few different roles currently of the chief investment officer and running a lot of our acquisitions for our verticals.
And in your time at Aspen, and what I always think, like when I look at my journey, it's the mistakes that I've made that have kind of given me the best education, the biggest learning. So can you talk about in your career with Aspen or beforehand, something related to real estate, maybe a challenge or an error, a mistake, or something that happened that you learned from?
Yeah, well, there's a lot, right? we learn generally most from our mistakes and from our failures than from the things that go really well. So I think if two that come to mind would be one, exuberance in the marketplace, and kind of when the crowd believes that everything can only go up, that's usually a good time to start to go risk on and pull back a little bit. And thankfully, we didn't take on any floating rate debt. We didn't take on any, aggressive bridge debt. And so our portfolio has actually done pretty well. But, there were some decisions made where maybe we took a little bit more leverage than maybe we wanted to on a certain deal. And, won't be fine over time, but the leverage goes both ways. And then just seeing some of the exuberance in underwriting, right? It's hard to not get when everything is going up, and up. How do you continue to have restraint? So I think that the market cycle is creating a lot of just correction of expectations, which I think is good and healthy. On the flip side, I think there's a massive amount of opportunity right now that we're seeing in several of our verticals. Very excited about. But we continue to be pretty disciplined in how we underwrite. We've never gone too crazy on our assumptions and how we structure deals, and so I do think it's an observation mostly. The other piece that's been more of a painful mistake is some of the earlier deals that we've done with other partners, where we had other GPs in the deal that we were relying on, have not performed the way we expected them to, right? I think the challenge for us was making the assumption that people would operate by the same rule book, the same value system, and the same level of ownership of investors' capital that we had, right? And that's just inherent of who we are. And that's not always 100%, right? So we've had to take over certain things that we didn't plan on doing. And again, thankfully, the deals are going fine, but it's created a lot of extra effort and time that was really we didn't plan on, and we're not making any extra money doing that, taking over responsibilities that should be done by people that we trusted. So, it's been some of the learnings, I would say, and we generally, now are keeping things a little tighter to the just our teams and building things in-house versus relying on other partners that we don't have long-standing relationships with.
Yeah, and I'm sure as you said, there's lots of opportunity now, and so being able to do that in-house is probably going to be an advantage to you guys moving forward. One of the things that people at Passive Pockets are interested in is creating wealth and financial freedom. And so can you talk a little bit about maybe what financial freedom means to you? Because it means different things to different people. So what is it? What do you look at when you think of financial freedom?
Yeah, I think of the freedom of deciding what I get to do with my time. And I think that's been a very rewarding thing coming from more of a corporate W-2 role to becoming an owner and a partner at a real estate firm. It's a lot more stress. It's a lot more work, putting in more hours, but I love every minute of it. And it's so rewarding and fulfilling. And I don't have to work as hard as I am, but I'm enjoying it. I'm a little bit younger, so I have the energy and I have the excitement to go do that. And so for me, it's really being able to stay engaged in the things I want to stay engaged with. Getting to hire people that I enjoy working with is a huge thing. And down the road, I'm sure I'll slow down a little bit, but I don't ever see myself fully retiring, quote unquote. It's just maybe doing more of the things that I'm good at and enjoy, and less of the things I don't. But right now, it's awesome. It's really, really fun to be able to be with a growing company, to have partners that are supportive of the growth, and getting to do with people that I enjoy working with.
Yeah, that's great. So final question, again, thinking of passive investors, limited partners, what do you think is one or two of the most important things that passive investors in syndication should learn, or that they should do to maximize their success in this particular type of investing?
Yeah, great question. And I don't know if you even know Jim, but Bob and I, so Bob's my father and partner, just wrote a book called Invest Like a Billionaire, which is after the name of our podcast, coming out later this year. And it's all about LP investing, the things that we've learned, as investors, but also being on the other side of it as a GP. And we talk about a lot of different things, that the mistakes that LPs make. So excited to share that when it goes live later this year. But one of the big things that we see consistently as being probably the biggest red flag is misalignment of interests between LPs and GPs, right? And this can look like a lot of different things. One is, what's the fee structure, right? What's the waterfall? Meaning, how does this cash get distributed, and to whom, and based on what? The ultimate, I think, barometer of alignment is co-investment, right? How much does the GP have their own skin in the game alongside of their LPs, that they stand to actually lose meaningful capital if it doesn't work out, right? Because what we've seen a lot of, and we have a lot of examples in the book, where different capital raisers go and raise money, for some kind of new sexy thing, right? And the examples I won't specify right now in the book, but there was no alignment. The sponsor didn't put any money in the deal. The deal didn't go according to plan. Nothing of the projections that they set out actually got hit. And ultimately, the GP decided just to walk away. And they had nothing to lose. They had none of their own capital in there. They raised about $50 million and handed the keys back to the receiver to figure it out. And the real big challenge in this whole thing was, they could have rescued it. They could have actually salvaged what was there, and likely could have gotten all the investor capital back. but they did it because they didn't have the skin in the game. They didn't want to go through the pain of it, the brain damage of it, the reputation damage of it, because they didn't have the skin in the game. So I think skin in the game is the ultimate barometer, and I think it's probably one of the most important things that investors should look at when they're looking at investing with sponsors.
And we've talked about that in the community quite a bit, and it is super important. And so, but the next step of that is, and asking, from an LP to an operator, when I ask you before I invest, hey, how much are you putting in? That's a legitimate question to ask, and I should expect you to tell me, right? But then on the other side, is it okay, or how do I prove that you've done it? Do I ask you hey, show me receipts that you put the money in? And what is, because sometimes that's uncomfortable asking, hey, Ben, show me your bank account to show that you invested in this deal. But is that an okay thing to ask an operator to prove it?
I think so. I mean, it's trust but verify, right? I think, if every investor asked me to show them my bank statements, that becomes an operational challenge. But I have no, ethical issue with someone asking me that. I think it's a good point of due diligence. Now, I mean, I think the other piece of it too is a lot of times lenders will require co-invest, depending on what the lender is, and they absolutely verify it, right? So you can even ask, hey, does the lender require co-invest? How much is it? And you can have confidence that the lender is generally going to be making sure that those dollars get in, right? So that's kind of a maybe not quite the same as getting the proof of receipts, directly, but one, I don't think it hurts to ask. I think that's the thing I think a lot of LPs don't realize, and as someone who works with a lot of LPs, I'm always surprised by the lack of diligence sometimes, right?
Yeah.
Like, hey, if you're comfortable with that, I trust we're going to do a good job, so you're going to be happy, and good on you, or good for you. But also, you should be probably asking a little bit more. So it never bothers me, right? We're very transparent, but I also think it could be a good barometer on the sponsor, right? And some sponsors may not, and they may have the reasons to, but I don't think there's any issue with that.
Yeah, and I appreciate that, because sometimes it is hard for LPs to understand, like, where is there a line? What questions can we ask without, but we're giving you a lot of money to steward, and so asking you questions like, hey, you said you're investing in this deal, prove it. That doesn't seem out of line. So appreciate that. And that wraps up this interview with Ben Fraser. We really appreciate Ben and Aspen Funds. Also, be sure to check out the book when it comes out. I guarantee you it will be fantastic. Also, check out the Passive Pockets YouTube channel and subscribe to our podcast for more great insights into the world of syndications. Thanks for tuning in, and as always, happy investing.